What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I am joined today with Sanjay. Do you prefer Dr. Sanjay? How do you like
Whatever
to
you
be referred
prefer.
to?
It's all good.
Okay. All right. So how are you today, Sanjay?
I'm doing great.
Excellent, excellent. And I got great news for you. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, it's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, syndicators, operators, investors, all that kind of stuff. And you may ask yourself, why would you want to do that? And the answer is, if you've ever heard of a 506B deal, that's one of the private off-market deals that you're not even allowed to publicly discuss. And so what I do is whenever I meet somebody new in this space, I have them onto this show for about 15 minutes to ask, what exactly do you do in this industry? And the benefit to you is you'll learn to more effectively communicate on the subject of commercial real estate deals and understand how my guest fits into those deals. But before we get too excited about commercial real estate, Sanjay, do you want to introduce yourself a little bit?
Yeah, I would love to. I love your form. I think this is great. I'm Dr. Sanjay Sharma. I'm a medical oncologist in Southern California, and I'm also an owner and co-founder of a private real estate equity company. So I'm here, obviously, not to talk about oncology, not to talk about cancer, but to talk about real estate, which I'm excited to go into.
All right, excellent. And the first segment I pull up on the screen here, and I got to say, but wait, check your eight. Doctor, I don't know if you have this technical ability or not, but to see into the camera and into the user's device down there, there might be this downright hideous eyesore of a subscribe button or maybe a bell or something. And maybe they should, okay, it's a silly joke, and I don't even know why I end up doing these. But the 5 distinct motivations, I do know why I put that up. It's because everybody has their own unique reason why they're involved in this industry, and it's important for us to know what that is because it's going to tell us whether the person's going to throw in the towel when the going gets tough. Because after all, these deals take months to close and years to go full cycle. So that's an important thing. And even though everybody has their own unique why, I find they fit pretty neatly into these 5 categories. The first one of which is preservation of purchasing power. Now, what's that? Now, some people, they are completely work optional and they have a portfolio of assets and that's how they make ends meet, is from those proceeds. Other people, they are earning far more than they are actually able to spend or ought to put into their spending monthly, and they need to find ways to preserve that purchasing power to stave off the effects of inflation. But the reason why people in this situation would want to make more acquisitions would be either basically if you're buying at a steep discount. The people who match this criteria, they don't have to make a deal every 3 months, every 2 months. It could be once every 3 years or something like that. But really, that's what they're up to. And I put it up here just to be full disclosure and say this is not where I am personally in my own career. Where I am is trading time directly for wealth. Now, my background is in technology. I was a full stack developer, and I suppose I still am, but I was in charge of online funnels through a CRM company that I ended up doing a spin-off agency to help people with their online funnels. And when I started working in 2014 for a total of 6 years with a guy who was flipping 10 houses a month, or at least doing 10 single family house transactions a month, I learned that I was on the wrong side of the right business. And so instead of seeking this higher salary, this higher wage, and paying a fortune in tax, I figured, how do I pivot where I'm rewarded in the form of deployed capital, aka equity. So that's what I'm up to. But a lot of people, especially youngsters, they're looking to hustle like crazy now so that they can retire early. Other people, they just want to be able to control their schedule and say, I want to work fewer weeks per month or fewer hours per week or fewer months per year or something like that. And that's fantastic. But it's important to realize that's not actually everybody. Some people believe that that is the motivation for everybody, but there are some that are more motivated by ambition. They want to buy their entire hometown because they want that generational wealth to make sure that their great grandchildren never have to hold a day job. And even though that's vilified in some circles, the fact is you need people who can really stay focused and see a project through to completion. And so that demands a certain level of ambition in itself. Now, of course, they're not the only people who are going to hustle into their 90s. There's the last group, which they, rather than their own generational wealth, they're more concerned about a sector of society, or maybe it's animals or the environment, or they want to send people to space or something. But the fact is, if you have a big project like that or a big group that you really want to help and change, there's a big price tag attached to that. And that's why some people are making their commercial real estate deals. So, Sanjay, as far as those five different motivations, what combination of those would you say describes you best?
Well, first of all, that's a fantastic explanation. I've been in a very animated way to do it, so I really appreciate it. I think it's great for your listeners. I personally talk about five freedoms, which you actually talked about, where I talk about geographic freedom, time freedom, mindset, financial freedom. You know, you're hitting on all of them. So I'm a full-time physician. All my colleagues are full-time physicians. So I recognize what goes into me being a doctor and taking care of patients. And I've always looked to how can I be a better physician to give to my patients? And likewise, how can I give back to my colleagues in society? And I found real estate, after exploring so many different asset classes, is the safest. So you talk about preserving capital wealth. In terms of different asset classes, I found that it's one of the safer routes to go. A lot of physicians are taught to, hey, you know, there's the retirement angle, which again you talked about, where you can retire at 67 or 70 years by doing equities through your retirement accounts, which I personally do. But I look for different opportunities to speed up that process. So maybe I can have a generation of physicians who are practicing not so much constrained by the stuff that we see on a day-to-day basis, whether it's our autonomy, whether it's the time needed to practice medicine, to freeing all that up. So we're better doctors. I can truly say I'm a better physician because I have some of these freedoms. I, like you, I continue to work. I continue to have these assets. I continue to do my research. I continue to be a doctor on a daily basis. So there's a combination of a lot of these, and I really appreciate how you're teaching your listeners and how you put it into these five categories.
I love it. Thank you very much. Now, the only risk, of course, of mentioning all these different motivations is you might sound overly optimistic. And the fact is that real estate, just like all businesses, have risks involved. And
Yeah.
since real estate is so mature, you have to make sure that you understand what exactly you're dealing with. Now, if you've ever been involved in one of these off-market deals, these private 506B syndications that I'm talking about, then you should have had to fill out this pretty invasive financial questionnaire, asking about like net worth and things like that. It's not much fun, but as a person who had to produce these different questionnaires, make sure that their compliance is in place and all that sort of thing, when I got to the question of risk tolerance, I felt all of the different multiple choice answers, they weren't, it lacked utility. I couldn't really trust any of the answers. So I made my own one, which is a fill in the blank. It is. There are many popular investment asset classes, but I think blank is too risky. So Sanjay, it can be inside real estate, it can be outside real estate. What's too risky for you?
Oh, so it's actually one of the reasons why I got into real estate. So instead of a a one-word blank answer. I mean, obviously, the answer is going to be crypto, but I'm going to voice it in a different way. I clearly remember when I started practice, and there was a very well-respected senior pathologist who I assume was doing pretty well, and he was getting ready to retire, and he was actually retiring, and that was the great financial crisis. All of a sudden, he couldn't afford to retire. He actually came back and said, "Hey, can I work more? I can't do this." And I said to myself, wow, that's risky. Like, I've been taught my entire life that that's the way you go. You do the pre-tax retirement accounts into equities, whatever it may be, 403b, 401k. There's others, and again, I will preface it by saying that I'm heavily involved in those, and I do invest in it. But it really scared me to think I was an early career physician to think, well, shoot, in 30 years from now, after all that work, by a change in the great financial crisis, that all of a sudden we can't afford to retire, that to me is risky. And it really made me think about, well, what do you do with finances? How do you set yourself up in a safe way? How do you achieve the goals that you want to achieve, whether some people actually have a number? You know, I like the way how you did it, where you described all the different freedoms, and how do you achieve that? And this is one avenue in what I feel as, in the right hands, a very safe, vetted way of going about it.
Hmm. Yeah, I love that answer, and you know that I try really hard not to get people to, not to color which response they have. So I actually use a pretty ridiculous example, and I know that crypto's coming half the time because it's an appreciation move. You buy low, you sell high, or you lose. It's not a very sophisticated model, even though they have a scarcity play apparently. But here I am nerding out on numbers and stuff like that, and I gotta confess, the first couple hundred chance encounters, I didn't include this slide because I felt it wasn't fair to people who are more on the investor relations and even more on the marketing side of investor relations, because they're not going to be spreadsheet people in general. Now, when it comes to this one here, though, I decided to include it because even if you are more on the public facing side, you'll at least have some deal metrics that you tend to rely on to distinguish one deal for another. And for anybody in the audience who's only listening and they're not watching, I'm going to read them out. The first one is cash on cash. Second one is IRR. Third one is cost per door, and then net operating income, or NOI. Then going in cap rate, and really that means the difference between what the going rate in that area is for a commercial building that's similar compared to the price that you're getting at, so it's really a discount. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. Then there's the occupancy rate. Now, just know that's the inverse of vacancy, so that's the same thing but upside down. Then there's average income, where the property is located, the amortization period of the loan, the difference between the market and in-place rents, the population growth in the area where the property is located, the sponsor record, which is the number of deals that have already gone full cycle and the number of deals that are on the go already. Then there's the waterfall, split, or exit strategy, which means basically what happens to your investment after your principal has been returned. And then there's DSCR, which is debt service coverage ratio, which is actually the percent of the revenues that's going out the door immediately just to pay for the loan. Now, Sanjay, this isn't an exhaustive list, but do you want to give like a top three as far as
Sure.
numbers you tend to rely on?
Yeah, that's great. Again, I compliment you on what you're doing in terms of education. It's almost like you're giving a textbook and then you're going to simplify it. So awesome how you do it. I would say for an investor, you got to look at the sponsor record. That is probably your most important piece before you invest your dollars. The chances are you're never going to go to the property. You're never going to see it. You're never going to look at the inside. You're never going to call the tax records to see what the taxes are in the county, or look at the pipes or the plumbing, or interview the tenants, or check on the insurance, all that kind of stuff. You have to rely that the sponsor is going to do that. And quite frankly, a deal is going to be made into a deal by a good sponsor. I mean, that's our job. We're professionals at this. This is what we do all the time. And so I think that's far important. Other ones I look at is IRR. So that's giving you an idea about your rate of return on an annualized basis. So, for example, if a property returns capital to you and profits on a shorter time basis, it's going to be a higher IRR. And but I would say that also with a caution, because if you want to really dig into spreadsheets, you can find out how they actually calculated the IRR, which then goes back to the reputation of the sponsor. So those are all important. I wouldn't say you have loan interest on here. I wouldn't say necessarily the loan interest has as much of a importance, but maybe the loan product. And that's why we're seeing a lot of sponsors coming out of 2020, 21, and 22 and 23, where with interest rates that are floating and low cap rates, high LTV areas, meaning they borrowed a boatload of money, thinking that, oh, you know what, we're going to jack up rates and this property is going to be worth a whole heck of a lot more because every other property 2 months ago did that. They are unfortunately in a difficult situations, and even worse as the investors are in a worse situation. So it's not so much the loan interest, but how good is the loan in the sense of, is the money that has been borrowed, can it complete the project, and can it be there for the entirety of the business plan? I think that's more important.
I absolutely love it. I'm eating that answer up like a delicious subscribe sandwich. Like we were talking about professionalism, and as you can see, that's a very important thing to me. But that tells me it's time to bring up the Dan Does Deals Commercial Core Competency Cube, and I'm going to blast through these as fast as I possibly can. I'll actually edit out for you in the audience so that we can condense this a little bit more. But for your sake, Sanjay, the six
Yeah.
sides, the first one's the repositioner. So I'm also kind of covering for the fact that some people are going to call themselves capital raisers, and that's a no-no. Okay, so the repositioner is a person who actually does the underwriting, finds the deal, and finds out how can they make this property make more money than it already is. The main thing is they have to find out if the broker or seller is even telling the truth about it, because that's the most important starting point. Then I emphasize to the audience that the most peculiar part of being a repositioner is you have substantial financier relations, because if you can secure a more advantageous loan, that goes straight to the profitability of your building. So that means every repositioner is rubbing elbows with financiers. But of course, they don't deal with anything except for the owners of the building, paperwork, and money. Then there's the operations, and I emphasize to everybody that when I'm on a GP team, it's going to be a larger building because I'm going to be doing it from the internet. And my contribution is a marketing and digital asset role. So whatever you needed as far as websites or web assets, even including like tracking and full applications, I'd take care of that. But more importantly, if there's a vacancy rate problem, then even your third party property manager, they need somebody to step in who has marketing chops to get those units filled. So I throw my hat in the ring for that piece of the puzzle. But then I emphasize that a repositioner may get a contractor team involved to upgrade the property to demand better
Yeah.
rents. But of course, if you're like me, from the internet, you need locals. You need boots on the ground who can be there in an hour or two, because that will not be me. I'd be stuck at an airport in an hour or two. So I definitely outsource for that. But when a repositioner turns around to the financier and says, hey, I want to buy that building down the street, it's 150 units and it's tens of millions of dollars or whatever ridiculous number it is. Hey, do you have tens of millions of dollars you want to lend us? Well, the financier is going to tell the repositioner, well, you need to have a sponsor who owns a similar asset or you're not going to be eligible for a commercial loan. So the question is, who's the KP? And I emphasize that because new syndicators need to know that they need to know multiple syndicators, or else multiple sponsors, just because otherwise that sponsor can really like leverage you in a real bad way. So that's what I tell the audience, and then I come to where I'm editing right here. So Sanjay, of those six different roles, of course you're a physician, so you're going to be doing some financier relations. You're going to be a repositioner because you're really a curator of the different deals, and that means you're also going to be doing some asset management. But have I got that role right, or where do you expect to fit in your next deal?
Yeah, no, I think you do. I mean, I love the dice cube that you have. You did a fantastic job of gamifying what's involved in terms of the big asset class. So it's true to say, and I love how everything is connected because we all play different hats. I mean, quite frankly, there is not a part of that cube that I'm not playing a role. Now, I may not be spending as much time as one of my partners is talking to the attorneys, taking all the legal work, all the corporations and all that kind of stuff. But I am also helping making decisions about that. I may not be actually on the phone call with the broker in terms of looking at the loan products and the opportunities, but at the same time, I am part of that decision making. And I think that's true for all of us in this industry, in this business, that we do have primary hats that we wear, but we also take part in every single decision that's involved with that. And then we're all, and this is critically important, anyone in my field is all about investor relations. You know, my investors, I need to be there for them, understand what their needs are, and be able to provide that with the assets that we offer.
All right, I love it. So that brings us to the buy box question. And when real
Yeah,
estate people are asking about your buy box, we're asking
yeah,
about three things. It's going to be geography, size, and class. Now, when you're talking about
yeah,
geography, it's where is it? If you're talking about size, we principally talk about multifamily on this show, but there's other types of commercial real estate. But
yeah.
in multifamily, the way you define size is by unit count. And the reason why it's important is because the type of group that takes over 10 and 15 unit apartment complexes, they're going to be fundamentally different from the type that do 150 at a shop. So that size is still going to be important, even though some go off of square footage or acreage. But the third one, class, I prefer the term desirability. And
Mm,
the two parts of that are the condition of the building. In other words, how old is it? How beat up is it? How up to date is it? What sort of luxuries and amenities does it have included or nearby? That's the condition. But when you're talking about area, if you're talking about residential like multifamily, then the school districts are going to be very important. But other than
mhm.
that, you also have the crime rate where the property is located, and then the general amount of traffic that goes by. But the way that they rank these different classes, and it's the A plus at the top, and then A minus and B plus and so on. So Sanjay, what is your group's buy
Yeah,
box?
yeah. So Type 3 Capital, our thesis is we invest in land constrained Northeast corridors who are anchored by Ivy League medical centers. So we own, operate, develop next to UPenn in Philadelphia, and also in Boston next to Harvard. So we're very specific in terms of what we look for. We look for A class or developments, for example, or luxury A class buildings. We will have the nicest and newest buildings in University City of Philadelphia. And we specifically are looking to house physicians, scientists, and professionals. UPenn area is a global leader in terms of cell therapy, which is oncology research, and there's no housing for those doctors. That's where we come in. And then earlier you talked about kind of the five things that a person invests in or why they invest in, and you mentioned hometown. Well, to us, this is our hometown. We have spent years, if not decades, surrounded by medical centers. So even though you may not be from Philadelphia, guess what? All my investors and myself, we know what it's like to live in those centers. So that's what we do.
I
That's
love
my
it. I love
bypass.
it. Perfect, perfect. So, and then as far as the best people to reach out, me personally, because of my marketing background, the deal sponsors are the people who I've traditionally tried to attract, even though at the end of the day, we are in the industry of deploying capital. So, everybody in commercial real estate is interested in meeting new people who are looking to deploy capital. But, Sanjay, who's out there that you can help the most as far as the main roles?
Who, meaning contacted me or who contacted the others?
I'm saying people in the audience, if they are a deal sponsor or a financier, passive investor, repositioner, contractor,
Yeah.
who do you want to reach out to you the most?
Oh, investors, come learn with us. Come explore what it's like to invest in these fantastic opportunities, housing positions in Ivy League medical centers.
All right, excellent. And the next part is how to reach out. I'll sandbag that by drawing attention to this ridiculously long last name that I have, which makes me really easy to find, especially on LinkedIn, which is the social media platform that I spend most of my time on. But if you look way up there, you'll see a QR code. And if you're thinking about syndicating for yourself or raising capital for any kind of business, make sure you know the compliance details. That QR code goes to the FAQs page of 506B and if you're looking to include non-accredited investors, that's the one that you're kind of stuck with. And the purpose of 506B just to be clear, is that it's a backup service to make sure that you have documentation of your substantive relations with your investors, because even if your laptop falls into the bathtub, the SEC will still want to see that documentation to prove you weren't publicly soliciting people under a 506B. But Sanjay, if people want to reach out to you, should it be through a website or through a social media platform? How do you want people to reach out?
So I lived on LinkedIn. I'm on LinkedIn every single day. You can find me there. But ideally, come to our website, titan3capital.com. That's Titan, Roman numeral 3, so III, capital.com. Our information's there, our deals are there, and there's a contact us there. Come find us.
Perfect, perfect. And that brings me to my public service announcement. It's actually not for Dr. Sanjay, I should mention, because it is me just saying silliness and pretending it's a medical thing. So my public service announcement is if you've been watching this episode and experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button, or maybe it's that bell or something for notifications. And okay, full disclosure, I want people to hit the buttons, because then YouTube will actually start to pay for these videos instead of me, and I think that would be amazing, because I kind of feel like they're being deadbeats. But as far as what that means to you, it just means my videos may show up on your list of suggestions, but go ahead and ignore them, because I just appreciate the fact that you spent this time with me. Just like Dr. Sanjay, thanks for being my guest. This has been amazing.
That's awesome. Thanks for having me. It's been an honor.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting, it's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, well, you know, wherever you're at.
Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.